Well, thanks everybody for joining us today on our weekly market update. There's a lot going on, so we're going to get right into it. First and foremost, thanks for your questions. We're going to be covering two of them today. If you have other questions you want to ask us, obviously feel free to send them to us at our email address, or you can text those questions. Let's get right to the first one. What's going on with the market? Well, let's take that to our Florida office.
Thank you, John. And what's going on with markets? Obviously, there's been a lot of volatility, and we're in a correction. If you remember our comments from the beginning of this year, we said that after two very good years in the market, it would be difficult to have an up year this year. And we were looking for a flat year, maybe slightly up. The market was sort of overdue for some correction. We did not see a reason the market should fall significantly this year, but we didn't see a reason that it would go up a lot again after two great years in a row. The markets have corrected a little bit. The S&P, I think at the worst, is down 9.5%. The NASDAQ was down 14%. We'll show in the graph in a minute, those are not unusual intra-year corrections. The other thing you should know about this is a lot of the damage is coming from the stocks that outperformed the last 2 years, sometimes referred to as the Magnificent Seven. Those are taking a lot of the brunt of this correction, which is what we've been expecting and talking about since I think the second quarter of last year, that we would see a broadening out of the other 490 plus stocks in the S&P and not just the 7 or 10 that were outperforming. So I think that is expected. We are not surprised by that. If you look at this chart, and we'll make it a little bigger here for you. This goes back 40 years, and the black bars are basically where the market ended up for the year. The red dots are the intra-year corrections. And you'll notice a lot of years we had a correction. Famously, when you look back at it, 1987, and I was in the market, that we had the worst one-day decline in history. The market declined 22% in one day. Notice for the year, we were down 34% in 87. We actually ended up for the year, 2%. As you go through here, there's lots of years where we have strong performance, but intra-year, you can be down 10, 12, 13, 14, 18, 20%. It's not perfect, but the average is 14% per year. So if we're using the average intra-year decline, 9.5 on the S&P isn't even average. So from this standpoint, we don't see this as any more than a normal corrective period. We don't see anything changing from there. This is part of being in the market. You go through corrections, and we're doing it again. So I wouldn't lose a lot of sleep over it. After two good years, a correction is normal. We still believe that this year is going to be a slightly positive year and could end up down a little bit for the year. But this is like the second inning of a baseball game. This is early in the year. Things are going to change a lot over the next 9 months. I think that's enough said about the market correction. Let's look at the next question coming up. Oh, yes, what everybody's asking about, what's going on with tariffs? And I'm going to turn it over to JJ to talk about this and give us some overview of what we think is going on with tariffs.
Boy, you want to tell me? It's been a bit of a wild ride. You know that I said this joke last week, but it's still true. If you don't like tariff policy, wait 5 minutes, it'll change. Sort of like the weather here in Wisconsin. There's a lot going on. There's no question about it. And the tariffs, they conjure up a lot of feelings. Ultimately, tariffs. Milton Friedman said it best. If another country is willing to take taxpayer dollars from their citizens, put it into products, and sell it to Americans for cheaper than average prices, why are we upset about that? Tariff policies are disruptive. There's no question about that, and they're especially disruptive when they're not clear as to what they're going to be. If we look, and this is good to remember, this is the return of the S&P 500 from election day to election day, from Joe Biden and from Donald Trump. They both actually had pretty good first 100 days last go around. Then there was kind of a slump in the middle, or 2 years where things weren't so hot. Obviously, Trump had COVID, but then the final year for both presidencies were very, very powerful. And actually, overall, despite all that, had very similar returns for over a 4 year basis. But why is that important? Well, because we had tariffs starting to be put in place in 2017 and 2018. Right? We had a lot of tariffs. And by the way, those tariffs didn't go away. They actually stayed for all of the Trump administration. They stayed for all of the Biden administration. And they were actually strengthened in some regards during the Biden administration. Tariffs are inflationary. There's no question about that. But usually they're inflationary from a one time perspective. They're one step up in cost, unlike normalized inflation or cost push or wage pull inflation, where you see things constantly rising because of a pressure. We're not seeing that this time. So the question people have right now is all this tariff policy going to cause a recession? And uncertainty in and of itself, if you have enough uncertainty, think like Cuban Missile Crisis, you can actually cause a recession if there's enough uncertainty. But tariffs are not totally uncertain, even if we don't have great measures around them. Remember, manufacturing is somewhere between 7 to 10% of the U.S. economy. Services are basically 70% plus. Services are not usually directly affected at the same level as tariffs are. But recessions, although they're defined by the NBER, is fundamentally a demand shock, meaning that people stop buying things, and they stop buying things because something else is going on, right? I mean, the Great Recession was due to the fact that nobody could get credit anymore, right? People are uncertain. People have a wealth effect. They stop buying. Mass layoffs, right, across the board for huge numbers of workers. Those can cause recessions, but it's usually a demand-driven shock. So yes, tariffs are definitely they're the front page of every news cycle. We're not even talking about the fact the CPI number came in slightly below today. Of course, I spent most of last week talking about why PCE is more important than CPI, so shouldn't be so shocked. But from us, yeah, I guess what do we think about the economy? The economy still overall looks very, very strong. The tariffs are going to make a lot of headwaves or headlines, and if you're in the industry in which you're directly affected for some of these steel and aluminum tariffs, there's no question it's your whole world, and I don't want to discount that in any way. You have to put things in perspective, though. If 7%, 7-10% of the economy is manufacturing, and not all manufacturing is just steel and aluminum, the percentage of people that are directly affected isn't great enough to cause a demand shift in and of itself. So for us, it's something to keep monitoring. The tariffs change honestly day to day. It would be easier if they were more straightforward. But if you look back, and I think I put this graph in our weekly notes last week, talking about tariffs. Tariffs did not have a huge effect in 2017 from an inflation standpoint for the past 7 years on those products. People don't think that. Well, we must have had huge inflation there. No, it's a one-time inflationary move. So it's net negative from an inflation standpoint, but it's one-time net negative inflation. But with that, I think we're going to close out. Are there any other comments you want to have down in our Florida office?
Yes, I think talking about the demand shock is what's most important. Is and your comment about those industries, the industries that are affected, who are metal vendors, it's not going to be a good thing. It's going to be very difficult for them. And the price of autos are going to go up. The price of farm equipment is going to go up. Construction equipment is going to go up. Aluminum cans will be more costly. So for those industries, it could certainly cause a slowdown in demand. There might be less cars sold, less tractors sold. But overall, that is not going to pull us into a recession. As you said, the manufacturing is about 7 to 8% of our economy and about 7% of employment. Even if there's some layoffs in there, it's not going to be massive. Right now, we're still at record low unemployment. Consumers have very good balance sheets. Companies have very good balance sheets. So demand should hold up. Will this be a slight negative overall for GDP? Yes, it will. And hopefully this smooths out over time. But your point about the one-time increases, Now, 25% tariff on steel is a one-time tariff. You adjust to it. If we add 25% more every year, go up to 100%, that would be a different story. But I think everybody also knows this tariff fight right now is a way for the current administration to negotiate better terms from other countries on the products that they sell us or we sell to them. It's really too cloudy to come up with anything right now as a specific, hey, this is what's going to happen for sure. We're just going to have to wait and watch.
Yeah, for us, when investment firms are coming up with daily trackers on tariffs, they're not thinking like investors. And we've talked about this before. Day trading, the IRS reports to day traders, only 4% of them make money over a 3-year period. If we're starting to track things on the daily, we're no longer investors thinking in a 5 and 10-year term. With that, we're going to close out with our book, Good Energy. Attached should be the video from Jerry giving our book review. And with that, we're going to close out. Kind of trying to keep this a little bit shorter now. Thank you again for everybody for joining us, and we'll see you next week.
Have a happy St. Patrick's Day.
Happy St. Patrick's Day.